This is Daybreak Asia. We're counting down to Asia's major market opens. And Haidi, we're really just focusing on Japan amongst a host of other things. But Japan really with those wage negotiations, it seems like based on what we got on Wednesday, people in Tokyo should be pretty happy with some good salary increases coming through.
Yeah, and I suppose the issue is also how that works into expectations for the yen, right? Columbia Threadneedle, interestingly, saying it's more about the Fed than the BOJ when it comes to the direction of the yen. That the Bank of Japan liftoff, when it happens, has already been largely priced in. So let's get to the open.
Yeah, well, a big focus on really any sort of action. Do we get it in March? Does it come in April? But that's the focus here as we get underway with Japan just coming online here. We do have that Japanese yen holding fairly steady so far in the session, just a little bit firmer against the greenback today. But as we said, we did get those wage negotiations, the initial numbers coming out, the likes of Toyota, a bellwether there, meeting all of the salary demands. And so that is something that's been lauded by the likes of the Prime Minister, of course, Fumio Kishida. It's something that he wants to see and something that's certainly playing into the direction of the BOJ thinking whether we see any sort of move next week. Japanese yen strength, it has been something that has well weighed on equities, and we are just seeing them coming a little bit under pressure so far. But we also had US stocks retreating overnight, so it is that sort of a countdown. We have more inflation data that's due, PPI numbers as the last set before we get the Fed meeting next week. No change expected, of course, but it could be something that plays into the language that we hear from Jay Powell instead and the signalling that comes out of that meeting. So that's the state of play there for Japan. You do see the broader index just sitting flat right now. But let's take a look at how Korea is coming online as well. So the Kosdaq here you're seeing again fairly flat. The Kospi, yeah, pretty much flat as well. But watching the Korean won quite closely today because as we were just discussing in the last hour, the won to be tracking today because we do have the country and regulators there once again doing another trial to extend the onshore won trading hours. So it's really about that internationalization of the market. Can it make its progression into developed market status? Something to track that extension happening around the midpoint of the year, Haidi.
Yeah, take a look at what we're watching when it comes to Australia. We've got the sort of budget update, if you will, a little bit later, expecting some pretty good numbers despite these concerns over lower, of course, we've seen at play these lower iron ore prices, right, even though they have sort of stabilised a bit. But we are still eyeing that second surplus to be delivered in a speech by the Treasurer later on in Sydney. But watching other thematics in terms of the metals prices gains that we've seen, not iron ore, but certainly copper seeing that big move, and we are seeing that as the reason why we're seeing miners, materials showing leadership in the session today. More broadly though, that market here in Sydney being dragged down by banking shares, financials, communications sectors seeing a big drop. Aussie broadband, one of the big losers, down as much as 25% in the session, despite that upside that we have from metals. Copper spiking to that 11-month high. Take a look how treasuries are trading. Stabilisation is the name of the game. We saw strong demand for that bond auction. The final coupon auction drawing lower than expected yield. We're also seeing potentially a little bit of a reaction, as we heard from US Treasury Secretary Janet Yellen saying that it's unlikely that market rates will return to those levels that prevailed before COVID-19 that, of course, set off that wave of inflation and higher yields. But a few data points, the final ones, in fact, before the Fed makes its decision at its meeting. PPI and retail sales are in focus as well. But of course, it's the Fed, it's also the Bank of Japan, and in fact, there is some debate over which is going to be more of the impactful decision. Bloomberg has learnt that BOJ officials are considering scrapping the buying of exchange-traded funds, provided that their inflation target comes into sight. Let's bring in our Asia economy and government editor, Brian Fowler, and as we get the countdown to the BOJ, potentially one of the most impactful meetings in recent memory, what are we hearing here when it comes to these ETFs?
Yeah, so we've spoken to people close to the BOJ, and they've said that the policy board will discuss cutting off all new purchases of ETFs. This program, of course, was launched in 2010 as a means of boosting the corporate sector by lowering the cost of capital. Since that time, the BOJ's holdings now have ballooned to approximately 70 trillion yen, which is equivalent to about 1 year's worth of national tax income. And along the way, the BOJ has been criticized at times for distorting prices in the market and for sort of undermining the ability of shareholders to conduct oversight of corporate governance by taking such a huge share of the market. Now, in recent times, we've already seen the BOJ kind of pull away from that buying. Last year, the central bank only entered the market 3 times to buy ETFs. Earlier this week, we saw the Nikkei fall by 2% in the morning, which in the past would have triggered buying, but the BOJ held off this week, which is probably a signal that it's already pretty much stopped buying stocks. And it makes sense, of course, because when they started this program, the Nikkei was at about 10,000. Now we've recently hit the highest on record, and it doesn't really make a lot of sense for the BOJ to be entering the market in any case. So we're hearing that cutting off all new purchases is going to be under consideration. Bond market probably will still continue to get some support in order to keep yields from flaring up too much.
Yeah, it really does seem that we're on the path to normalisation, whether it comes in March, whether it comes in April. But you've also been looking at the winners and the losers that come out of any sort of rate hike as well.
Yeah, so I mean, before I go into that, but let me just emphasize that when the BOJ ends the negative rate, it's not going to be the kind of pivot that we might expect to see from the Fed later this year. In terms of policy, the rate will probably go to about 0.1%, which by global standards is, of course, still very low and very loose. But having said that, it is a change, and we would expect to see some winners and losers. Banks should benefit because they can start to boost their lending margins for the first time in a long time, especially regional banks. Companies that import goods, including food and beverage, would probably get a lift if the yen does start to rise, both from the BOJ hiking and then later the Fed cutting rates. That would also benefit companies that are reliant on energy, large amounts of energy in their production, such as steel makers. On the other hand, companies that are heavily indebted are going to take a hit. And according to Teikoku Data Bank, some 250,000 companies in Japan qualify as zombie companies. That's about 17% of the total. A lot of those companies will probably go under when they lose access to essentially free money. And I can make a little subtle segue now into public finance. Japan's public debt is the largest in the world as a proportion of the size of the economy. Those debt financing costs will go up. That could put a drag on fiscal policy going forward as the government tries to get its house in order.
All right, that was our Asia Economy and Government Senior Editor Brian Fowler there in Tokyo. And let's get more on the outlook for the BOJ. Bring in Isaac Poole, Global CIO at Oriana Financial Services. And we just heard there from Brian, we're not really expecting any sort of huge step forward in terms of rates, but do you think that the door's sort of closing somewhat on them being able to make any sort of exit away as well?
I do, and the Bank of Japan has this history of under-delivering, waiting too late to deliver, and that's really the challenge here. They've left things so late to move away from negative interest rate policy. They've had a technical recession. Inflation is moving lower. This won't be a big pivot. We might get 1 rate hike. Possibly we could get 2, but I don't think this will be a meaningful move higher. And the real risk is if the global economy starts to slow down, if Japan's economy meaningfully slows further, they could be cutting again by the end of the year, and that will be a real challenge for them.
We were just discussing the winners and losers there. In that sort of environment, does the equity market then win?
Well, I think with an initial rate hike, that could be a positive signal, actually, and moving away from this financial repression, interest rate repression that's been there for a decade or more, that is a positive development to start off with. But, I mean, we know the economy is slowing already there. Wages are being pushed higher. I think that's actually going to be a challenge for Japan's economy to digest that. And so if I look out over the end of this year, I think there could be some real headwinds to Japan's equity market.
Isaac, and that goes to our question of the day as well, which pertains really to what happens to the dollar and what's more impactful, the Bank of Japan decision or the Fed decision. But I'd also widen out to what's more impactful for risk assets more broadly, right? And I'm sorry, but I feel like the RBA is hardly going to get a look in on the same day next week.
Yeah, I mean, it is really all about the Fed at the moment, and the global investment community is only worried about what the Fed will do, how soon they'll cut, how far they'll cut, what that will allow the economy to do over the second half of this year. And we are seeing the US economy is slowing. The unemployment rate has moved higher. Retail sales were weaker in January. We'll get another read on that shortly. And unfortunately, this is all happening as inflation is being a little bit sticky, and there's a real risk that the Fed disappoints the market, even though the market has been dragged to that view of 3 rate cuts. And that's all that's going to matter for the currency. That's all that's going to matter for equity markets over this rest of this year, I think, because ultimately fundamentals are weak. Earnings growth is low. It's only margins that are holding out and allowing earnings growth to look positive. And if rates are cut because the economy is slowing, I think that could be a real catalyst for US equity valuations and a real risk to those extended valuations now.
Does that mean there could be a contrarian opportunity for China? Because certainly, whether it be actual, sight of incremental policy action or just the fact that valuations have been sitting so low and investors are a bit over that narrative, things seem to be improving.
They are. I think that it's really clear that China's economy is growing, although I don't think we'll see a re-acceleration. And the real opportunity here is 2 things. One is the relative valuations. They're very low, and they've probably bottomed out now. The other part is that China's authorities have been quite canny about releasing monetary and fiscal policy over the last 12 months. And so if we see a global slowdown, a US slowdown, then I think you'll see China will have plenty of scope to add to that stimulus. And I think that's what they're waiting for. And that means that if we get that slowdown, you have the benefit of relative valuations and what could be a real surge in policy support to Chinese equities.
And when it comes to policy support, I think if you look at the performance of Chinese equities, the ones that are sort of tied to the new economy are the ones that have been faring better. So renewables, materials, some of the more smaller growth stocks as well, on that AI perhaps bet, that tech bet. But is that the sector that you really want to be going into, or those sectors?
I mean, globally, that's a sector that is stretched, AI and tech, but it is the new economy. I think that's been the focus of Chinese authorities over not just the last year or so, but we're talking many years, this move away from the old industrial-led, investment-led growth to something that represents domestic consumption, that represents domestic research and development and know-how. And so they are the areas you probably want to focus in on. But again, you do need to be wary of the global beta to tech and the risks that those look stretched.
All right, Isaac, thanks for your time this morning. That was Isaac Poole there, Global CIO at Oriana Financial Services. And let's take a look at some of the movers we're tracking so far in the session. 12 minutes into trade so far. This is what we're seeing in terms of Nippon Steel here. You can see that's moving a little bit higher. We did actually see US steel falling overnight because there is that concern around the proposal that Nippon Steel has to purchase United States Steel Corp. That's according to sources with the sources familiar with the matter are telling us that President Joe Biden could soon release a statement of concern about that deal. So, as I said, US still under pressure. We're not seeing that translating across to Nippon Steel so far. Also keeping an eye on some of the automakers here, because we do understand that Nissan is weighing EV parts partnerships with Honda. Both of those are moving a little bit high so far. Let's change on, because as I mentioned, Nippon Steel, but it is that focus on the copper linked names as well today, because we did actually have reports that Chinese copper smelters could be weighing capacity cuts that drove the price of copper higher to around a 7-month high. And we are seeing copper names moving higher today at the start of trade in Japan and Korea. We've also seen them gaining in Australia so far. And if you take a look at that, is really the action so far in the market session. But Haidi, broadly today, we are just seeing equities treading water so far. It does kind of follow what we had in the US session. It's that countdown really to the last inflation print, expectations again around what the Fed does next week, what the BOJ does as well.
Yep, and of course watching the tech space as well as we get into the start of trading later on in China. We'll be watching any kind of follow-through from this bill to force a sale of TikTok in the US, headed to the Senate now, setting up a fresh flashpoint between Washington and Beijing. This is Bloomberg. Well, the US House of Representatives has passed a bill to ban TikTok in the US unless its Chinese owner sells a video sharing app. Georgia Republican Congressman Buddy Carter told us supporters of the bill see it solely as an issue of national security.
We're not talking about banning TikTok. This is up to TikTok. This is up to ByteDance. They make the decision on whether they want it to go away or whether they want to divest themselves of the ownership of this. This is two questions here. First of all, this is a question about, is it going to be banned? No. They have to divest themselves. That's a question that only they can answer. The second question is us in Congress, us in the House and in the Senate, and that is, this is about national security. Now, are we going to take national security seriously? The number one responsibility of the federal government is to protect our homeland and protect our citizens. We have to take it seriously, and it is about national security.
Congressman, thank you for your time this morning. Project Texas was the plan whereby the US user data of the TikTok app would be housed in data centers onshore here in the United States, owned and operated by Oracle. Were you not convinced of that plan such that you co-sponsored this bill? Why did that not work?
No, it doesn't matter where they are based. If it's owned by the Chinese Communist Party, that's the problem. And that's the responsibility of Congress. That's our responsibility to guard against these kind of national security issues. That's why we acted on this. And, I would beg to differ with some of my colleagues who are saying, oh, this was too rushed, this was too rushed. We've been talking about this for a long time now. And remember, TikTok has been banned on government phones for some time now. So this is not anything new. And again, this is not a ban. We're just saying that ByteDance, the parent company of TikTok that is owned by the Chinese Communist Party, they must divest themselves of this.
That was the Georgia Republican Congressman Buddy Carter speaking to us on Bloomberg Technology. And for more, let's bring in our executive editor for Asia Technology, Peter Elstrom from Tokyo. And Peter, it's not clear if this bill will become law, but what we do know is that TikTok is not going to go down easily on this one either.
Yeah, that's right, Annabelle. This bill has picked up quite a bit of momentum. I think it surprised quite a few people, as mentioned briefly. This has been talked about for years, dating back to the Trump administration, and it's stalled in various forms and for various reasons. But now we saw it pass the House with a very strong majority. It's headed towards the Senate. The fate there is uncertain. Senators have expressed some concerns about this. It's not at all clear that it's going to pass the Senate, but it is very much possible. And then Biden has already said that he's going to sign this into law. So what does TikTok do? What does ByteDance do because of that? As we reported, they are planning a legal strategy to fight back against this. They feel like they have legal grounds to be able to stop this, at least to slow it down, partly over free speech grounds, partly because they have not they feel like they have not met the burden of proof that there is any kind of influence that TikTok is using in the U.S. So we can anticipate there's going to be a legal fight. One of the questions, of course, is whether they will have to proceed with some sort of separation in the short term, even if they do continue to fight in the courts.
Peter, can we game out some of the possible longer-term scenarios? Like, would they sell? Who would they potentially sell to? Could they not sell and just survive or thrive without the US market?
Yeah, those are all very good questions. So the strategic options for ByteDance, the parent company of TikTok, would be probably at least threefold. You alluded to one. Could they just close down the U.S. operations? They could. They have about 170 million users there. TikTok is very, very popular globally, but the U.S. is its most lucrative market, bringing in the most revenue. So that's a bit of a challenge for them. They could also separate the U.S. market, keep the rest of TikTok globally, but separate the U.S. market and let that stand alone. That is difficult from an operations standpoint and a cost standpoint because you have to operate it separately from the rest of TikTok, probably with separate management and, as we were talking about, separate data and privacy issues. Or they could look to spin off TikTok itself globally, not just in the U.S., but globally. That strategically has a lot of appeal. I think from a business standpoint, that would free the company up from the overreach of ByteDance in particular. It would alleviate some of these political concerns. You'd have a very powerful tech company that could compete with the Metas, the Facebooks of the world quite aggressively, probably Google also. They do have tremendous reach. They've got a very strong global presence. The problem there is that ByteDance would lose. Perhaps they get compensated in some way, but they would lose one of their most important operations. And the Chinese government has said that if ByteDance wants to proceed with any kind of spinoff like that, it needs to gain approval from Beijing first. They're concerned about IP from China going into other markets. So they have to deal with not just the U.S. government here, but also the Chinese government.
Peter Elstrom there, our executive editor for Asia Technology, just talking through some of the possible scenarios as TikTok gets ready for this fight. You can get a roundup of the stories you need to know to get your day going. Today's edition of Daybreak. Bloomberg subscribers can find that at Daybreak on their terminals. It's also available on the mobile in the Bloomberg Anywhere app. You can customize those settings so you just get the news on the industries and assets that you care about. This is Bloomberg. Well, as Australia grapples with rising housing costs and record migration growth, the government is working to boost housing supply. But in Sydney, some residents are protesting a plan to build higher and denser apartments around the city. Bloomberg's Paul Allen reports.
The name of this protest is Save Sydney. Depending on your perspective, it may be doing the opposite. These protesters want to stop planning laws that would allow more high-rise housing in their suburbs.
Save our suburbs!
A housing shortage is one of the reasons Sydney property is among the most expensive in the world. There's a desire among city planners and the state government to increase supply and do it by building up instead of out. Greater Sydney has relatively low population density, with 429 people per square kilometre, compared to the wider New York metropolitan area, which has 681 people per square kilometre. Still plenty of room to move there compared to Greater London, with more than 5,500 per square kilometre, and with more than 7,000 people crammed into a square kilometre. Hong Kong makes Greater Sydney look like a peaceful village, and the villagers like it that way. To those who have closely studied Sydney's refusal to grow up instead of out, this type of protest is disappointing but not surprising.
We are seeing many of those apartments threatened.
There is resistance in some parts of Sydney to increasing density, and those are inner areas such as eastern suburbs and northern suburbs. In those areas, we have affluent population living with highly developed social media skills. They're very well organized. They can influence politicians and so on and so forth.
Change is already happening. The New South Wales state government is spending $37 billion on a new metro railway, one of the biggest infrastructure projects the city has ever seen. The stations along its route and other existing rail corridors have been earmarked as locations for high-density housing.
Cities are not museums, so they have to change, they have to evolve over time as population grows, and Sydney's population is growing significantly.
And while the debate over where to house that growing population continues, house prices and rents continue to rise. Paul Allen, Bloomberg, Sydney.
We're taking a look at how futures in Europe are just coming online, and you are seeing them trading pretty much sideways at this point in time. Of course, very early moments here, but it does sort of reflect the tone across markets that we're also seeing in Asia this morning so far. It's a bit of a countdown to the US PPI numbers. It's also just very much wait and see ahead of the Fed meeting next week. There's the BOJ as well playing into it, but that is the state of play for European stocks. We are seeing the euro there again, very, very steady, but we'll have more ahead on Daybreak Asia. This is Bloomberg.
Take a look at the Korean won. We are seeing a little bit of weakness now for a third consecutive session. We did see that sell-off at the start of the week being sparked by the quicker than forecast US inflation numbers. That's been, of course, boosting the dollar. The dollar has been pretty range-bound, though, over the past session or so. But certainly we have seen really the side of the Fed, the side of US data offsetting the impact of what had been better than expected labour market numbers out of Korea as well. But also when it comes to the won, we've got some structural changes ahead when it comes to won trading. South Korea is doing another test of after-hours trading of its currency as authorities prepare to extend the won's trading session. Let's bring in Bloomberg's Hyo-yeon Kim, who's got the latest for us. Hyo-yeon, so what are we looking at here?
Hi, so South Korea has been bolstering its efforts to improve foreign investors' access to local markets here. Notably, its FX market, which only trades for 6.5 hours. And plus, offshore investors have been banned from participating in the local FX interbank market as well, which means these investors have had to rely on non-deliverable forwards to manage their exposure to the won outside Seoul trading hours, which is very strange for a country that has some of the biggest, fourth largest economy in Asia. So the government has been trying to change that, and so far they've let some investors trade onshore in the interbank market, and most importantly, they will be extending trading hours by about 10 hours starting this July. And so today, which is after markets close, the government will be conducting its third test, and during which they will let some of the participants to trade freely on real time. And it will be the first time they do so, and they will see, check, to have an idea of what kind of consequences they could see when hours are extended in July.
And so what are the implications of that then?
Well, obviously, the move is to improve global investors' access to the won, which could drive more inflows in the future. It could also pave the way for Korean bonds and equities to be added to global indexes at index providers like the FTSE Russell and MSCI, which the government has said could bring in tens of billions of dollars into the market. Still, there are a lot of hurdles left. The government, the offshore trading of the won will still continue to be banned, and foreign investors will have to trade through authorized brokers in Korea, which will make it easier for the government to monitor all these transactions. And it will take some time for traders in the MDF market to set up a new process to trade the onshore won. So implication may be small at first, but generally speaking, markets have been telling me that it will be a positive move.
All right, that was Bloomberg's Hyo-yeon Kim there. And let's take a quick look at how markets are faring so far, because we're 30 minutes into trade for Korea and also Japan this morning. The outlook, well, we're just getting a little bit under pressure here so far. We did actually see US stocks slipping overnight. We saw the big tech names, also more of the laggards in the session. And when you take a look at the IMAP function, you can see here tech is leading the retreat so far in Asia. But that's the state of play there. Let's switch on, because the commodities story is also playing into the moves, particularly in Australia today. And we are just keeping an eye on what's happening in oil markets, given we did see oil gaining in the prior session. Today it's fairly flat so far, but there was that Russia refinery attack, and also we're seeing that retreat in US stockpiles. Copper to note, because we did see it hitting a 7-month high yesterday in the session. Today it's just a little bit firmer here so far, but it is that question around whether Chinese smelters are going to be pushing through capacity cuts. That's what really drove up the price of that key commodity. But as I said, tech really in focus today so far in Asia, given we are seeing that weakness in that sub-index. But Apple's main iPhone maker, Haidi, is reporting fourth quarter earnings later today. The company is on track to report its second straight period of strong profit growth. That's as demand for AI hardware helps offset weakness in iPhone sales. For more, let's bring in our Asia tech reporter, Jane Lanhee Lee in Taipei. And Jane, yeah, just talk us through, what are we expecting? These numbers said due out later. It does seem it could be a little bit more positive.
Yeah, we'll have to see whether the fourth quarter earnings come in, as analysts suggest, a second consecutive rise in net profits. That's probably the last quarter that gets to be compared to a time when things were more difficult in China with the COVID shutdowns. But investors will also be focusing on any color on outlook for what's happening in the current quarter, especially because Counterpoint Research recently said that Apple, iPhone sales in the first 6 weeks of this year were down well over 20%. And so that's raising a lot of concern that, Haidi, which gets over half of its revenue from Apple sales, Apple product sales, could face a difficult quarter. The current quarter could be a difficult one. So investors will be looking for some hints on that.
Does that potentially get offset by demand for AI hardware?
It's hard to say because AI hardware is now ramping up, and the iPhone sales, make up such a big part. So it's possible that we won't be able to see the benefits of that ramp up yet of AI server sales. But perhaps going forward, that'll at least help alleviate some of the difficulties on the consumer electronics side. But those will be things that investors will really be looking out for. And news coming forward of any new contracts for AI servers with any of the tech companies that will really continue to help boost shares. Already this week, in the past week, Haidi shares jumped by like 15%. And so there's quite a bit of optimism, at least in the market, for AI server sales.
Our Asia technology reporter Jane Lanhee Lee there in Taipei. With the latest developments in Chinese property firms, we'll get you up to date with China Vanke's long-dated dollar bonds slumping, signalling that markets remain fearful a default may come. One note due in 2029 fell to as low as 40 cents on the dollar this month. It is an indication that investors still see the possibility of default despite the company's links to the government. Its short-dated notes, though, are trading near par, showing less concern of an imminent implosion. Country Garden has missed a yuan bond payment for the first time as it faces a lawsuit seeking its liquidation offshore. The builder says it has not fully prepared a $13 million coupon that came due on Tuesday for a yuan bond maturing in 2026. It has a 30 trading day grace period. Country Garden says it will try to raise the money through sales, asset disposals and spending cuts. More to come here on Daybreak Asia. This is Bloomberg.
You're watching Daybreak Asia, taking a look at some of the geopolitical stories or political stories we're tracking today. And US Secretary of State Antony Blinken is calling on Israel to dramatically boost the amount of food aid getting into Gaza. Blinken says supplies that are allowed in since the start of the war are still not enough. He's urging Israel to open more regular and predictable access points for overland delivery to avoid looting of relief convoys.
The bottom line is, we need to see, as we've described it, we need to see flooding the zone when it comes to humanitarian assistance for Gaza.
Russia says Ukrainian drone attacks have halted operations at 3 of its oil refineries. Russian President Vladimir Putin says the strikes are meant to disrupt presidential elections later this week. An aerial attack caused a fire at a Rosneft facility that is one of the country's biggest crude processing operations. Ukraine is ramping up the strikes to hamper Russia's oil product exports. China's Foreign Minister Wang Yi is set to travel to Australia next week in the latest sign of warming ties between the two nations. The highest level visit from Beijing in almost 7 years will come as China weighs the possible removal of tariffs on Australian wine. Wang will arrive in Canberra on March 20 for talks with his counterpart, Penny Wong.
And of course, ahead of that, we have been watching the move higher earlier in the week when it comes to Australian wine stocks. Treasury wine stays Australian vintage. A couple of the ones we're watching, we're seeing Treasury wine extending those gains that we saw yesterday. Of course, we saw a big bump for that part of the market, given these expectations that a proposal has been floated by Beijing to end these tariffs of almost 220% that have been in place for almost 3 years. Let's bring our next guest, who runs the family-owned and operated Taylor's Wines in Australia. Managing Director Mitchell Taylor is with us. Mitchell, time flies, right? The last time we spoke to you was actually when these punitive tariffs took effect almost 3 years ago. No doubt you're relieved. We see the relief across parts of the market as well at this potentially improvement in the relationship. But can you tell us how that's actually impacted your business over the past 3 years?
Yeah, it certainly has. It's been a very rough time for Australian winemakers. We've actually found that over this period, not only were we dealing with COVID, inflationary pressures of the entire supply chain, our own agricultural risks with drought and frost. So it's been a very difficult time for the business. We've managed to look at other markets within the Asian region, but we've been really waiting for this decision because we earmarked a lot of investment, a lot of our very best top-end wines, like the Legacy that we designed for the Chinese market. It'll be great to have our premium Cabernet Sauvignons and Shirazes back in the market. But it will take quite some time to readjust and to get used to all the change that has occurred from 3 years ago when Australian wines represented 40% of all the exports out of this country was going towards the China market.
This is also an issue of what's happened in 3 years, right? Obviously, the pandemic, we now have a slowing Chinese economy, a consumer that is, tightening their wallet, certainly, and spending. Are you worried that consumer tastes and preferences and that market share has been, in some ways, permanently changed over that period?
Yes, we are. We actually believe that the French winemakers and the Chilean winemakers took our market share, but with that, they also built all the branding, all the marketing, and all the trading relationships that are so important. And they're very complex, and they're always changing in China. But the good thing has been that people still remember our brand. They still love the taste of great Australian wine, the richness, the structure. We've continued to invest with people in the region to keep the brand alive. And we've entered wine competitions in China. So it's been great to see the anticipation and the respect that our brand still has after being out of the market for 3 years. I was actually, while we're busy with our vintage period on, I was actually in Hong Kong last week preparing meetings and preparing for this hopefully good news to come out later in the month.
We've already heard from Treasury Wines talking about preparations to reallocate a portion of their Penfold stock as soon as this announcement is made. How quickly are you able to pivot to be able to get distribution and supply chain back into China?
It takes some time. You've got to make sure your relationships are in place. So there's a lot of documentation, a lot of work that we're proceeding on. But hopefully, we have prepared these wines. We have anticipated that there will be this opportunity. So hopefully we'll be able to roll that out fairly efficiently over the next 2 to 3 months. But in having said that, we realise we've got to do a lot of hard work, a lot of visits, a lot of shoe leather will be required to really rebuild and reintroduce our new vintages to the market.
You've only got so much bandwidth and so much capacity, of course. So if you focus so heavily on China, which markets are you expecting that you won't be sending as much wine to then? Or is it simply that you've got so much supply right now that you can meet the demands in various markets?
We've got good supply, but strategically we've been really concentrating on the rest of Asia. You know, Hong Kong is a great market for us where we've just launched our wines last week. Also Southeast Asia have really been good little pockets. So they've all been working well. We've also just built new relationships in South Korea. So it's the whole region we're really looking at focusing. And also having a very strong domestic brand really gives us that pedigree of being, you know, a family winemaking business for over 55 years. So that's really helped, not only at home, but in some of our other international markets around the globe.
Yeah, in the UK, which was sort of once a prime market for cheaper wines, has now actually become your top destination for premium ones instead. What sort of demand are you expecting from there?
Yes, well, that's another journey that we're particularly, as a member of Australia's First Families of Wine, we're really starting to market our top premium wines in that market, because I think a market like the UK, they have very good palates, they appreciate quality, but really they're still to discover the scale and scope of the very high-end Australian wines in that market. So there'll be a lot of investment required from Wine Australia, relaunching our brand, getting the excitement back into the category, and also, you know, the education with all the new innovation that has been happening within the Australian wine industry. In fact, our wines have been continually improving, and it's very exciting to see the quality coming through. And some of the big international awards that we've won around the globe. Just last week, there was a big trade fair in Germany, and we actually won the major award over there for our Sauvignon Blanc, and we've also won it with several of our Shirazes with gold medals across the entire portfolio. So these are just positive signs that the quality and improvement in innovation is coming out of the Australian wine world, and we're really looking forward to sharing it with our customers, with hopeful good news about to be announced that the tariffs will be off Australian wine in the Chinese market.
Yeah, that's right. As we said, that big focus on China's Foreign Minister Wang Yi visiting Australia next week. But that was Mitchell Taylor, their Managing Director at Taylor's Wines. And you can watch us live and see our past interviews on our interactive TV function, TV Go. There you can also dive into any of the securities or Bloomberg functions that we talk about. Plus, become part of the conversation by sending us instant messages during our shows. This is for Bloomberg subscribers only. Check it out at TV Go. AIA says it's expecting continued growth in its businesses in the ASEAN region, mainland China, as well as Hong Kong. Group Chief Executive and President Lee Yuan-seong spoke to us exclusively after the insurer reported a 30% increase in new business value last year.
Well, excellent results. We are very happy. As you said, we delivered a very strong VONB growth of 33% in constant exchange rate terms. And this is broad-based. In fact, we delivered double-digit growth in 10 of our markets across the region. Our four major growth engines of ASEAN, which is the largest growth engine, Hong Kong, China, and India all delivered very strong double-digit growth in 2023.
For Hong Kong, what is the outlook with the removal of extra stamp duties and the new capital investment entrance scheme as well? Do you see that as having an impact?
We grew 82% in Hong Kong in 2023, and this is driven by strong growth in MCV business and also the domestic segment as well. I think we service the middle class and affluent customers in Hong Kong who have a very robust demand for insurance products. And we are seeing that the momentum of MCV business is continuing very strongly into the first 2 months of this year.
Could you quantify that a little bit more? Because we have been crunching the numbers or within the Bloomberg intelligence team, and they're saying for every 10% increase in Hong Kong's new business value over the course of this year, that could equate to an average boost of 3.6% for your business. Is that something that you're expecting as well?
As well, we see that we see continuing momentum in our MCV business growth across the into the fourth quarter and carrying on into the first 2 months of this year. We are very confident that of the prospects of our Hong Kong business as well as our mainland Chinese and ASEAN businesses and also India into the 2024.
AIA Group Chief Executive and President Lee Yuan-seung there speaking exclusively to us a little bit earlier. Take a look at some of the corporate headlines that we're following. And Volkswagen ADR slipped following warnings of a difficult year ahead. The German carmaker says it expects to fall further behind in China, where bruising price war is hurting returns. Volkswagen says it's willing to give up a sales share in the key market this year and next to improve the long-term business outlook. It also gave guidance for declining operating profit in China.
We are deliberately prepared to give up market share in the next, I would say, 1 to 2 years, 2024, 2025, in order to find a sound compromise between margins and volume. But from 2026 onwards, we want to regain share also in the BEV segment.
Reddit is said to be telling potential IPO investors that it expects revenue in 2024 to grow by more than 20%. A source says it's been giving guidance for similar growth to last year when sales jumped to about $800 million. That is it for Daybreak Asia. Our markets coverage is next.